most popular profitability metric is gross profit margin and EBITDA margin. I'm going to group these two together just because the calculation is exactly the same. It's just using different indicators, but the calculation is the same. Now, even though the calculation is basically the same, they are measuring different things. So the gross profit margin is mainly measuring a company's production efficiency. So it's measuring how efficient we are using our resources to produce revenue. In other words, how efficient is our production? Whereas the EBITDA margin is measuring the company's profitability. It also measures how well the company is using its resources, but how we think about EBITDA margin is its profitability, and gross profit margin is how efficiently we are using our production resources. Now, the calculation is, like I said, exactly the same. We are taking the gross profit, or EBITDA, and dividing it by revenue. Nothing too crazy or fancy there. Now, as an example, let's say that company has $100,000 in revenue and $25,000 in cost of goods sold, or COGS. Well, the gross profit margin would be 75%. And how we calculate that is we take the $100,000 in revenue, we subtract out $25,000 in COGS, and we divide it by $100,000 in revenue. So as a general rule, either ratio just needs to be compared to your competitors in the field. Now, the higher, the better, but there's not a hard, fast rule of what you want your ratios to be. It is very, very, very dependent upon industry. So as an example, I'll use the software industry. In the software industry, you want your gross profit margin to be above 75%. Anything less than that is not good. You want it to be above 75%, and really you kind of want it above 80%, but 75% is sort of like the threshold within the software industry. Now, within the food industry, that margin is going to be a lot lower. So whenever people say, oh, the margins are really low, what they're usually talking about is the gross profit margin. And what they're saying is it takes a lot of money to produce this item, and we can't sell it for much more than what we produce it for. So for instance, at a restaurant, it might cost you $3 to produce a hamburger and french fries, and you sell it for $6, well then your margins would be 50%. So they will definitely be lower than the software industry, where all they have to do is create one software and then just sell the heck out of it and make tons of money. And so that cost of goods sold is very small for them compared to the revenue that they can make. So that's what the gross profit margin is measuring. So let's go ahead and go back into our spreadsheet, and let's go ahead and calculate the gross profit margin and EBITDA margin, and let's analyze that at this particular company, Food and Stuff. All right, so we're back in our spreadsheet, and we need to calculate the gross profit margin and the EBITDA margin. So before we do any calculations, let's just go back to our income statement and make sure that we're looking at all the right things. So I'm going back to the income statement, and I'm going to the top, and right up here we have net revenue, we have the cost of sales or cost of goods sold or whatever you want to call that, and then we have the gross profit. So the gross profit is just taking the revenue less the expenses to produce that revenue, the money it took to produce that revenue. Once again, if you were like a car company, it'd be the cost to produce that car. It doesn't include all the marketing costs. It doesn't include all the costs of all the salaried people who are running the executive team and all of that. This is just the cost to produce that particular car. So in this case, the gross profit is $27 million. Now to calculate the gross profit margin, we are going to take the gross profit right here, the 27 million, and divide it by net revenue. And then to figure out the EBITDA margin, we will go down here and we'll take EBITDA and divide that by net revenue. So let's go back here to the financial analysis tab. And what we are going to do is do equals for the gross profit margin. I will come over here, select on the gross profit, and divide it by the net revenue. Hit enter. And we see that the margin is 27%. So it's not fantastic, but they are a food company, so it kind of makes sense that their margins are lower than like a software company. If you are a grocery store and you have to buy meat for $1.50 a pound, but you can only sell it for $3.50 a pound, well, then your margins are going to be pretty small. So grocery stores, retailers, usually their profit margins are a lot smaller than other type of industries. So to compare this over time, let's go ahead and copy this to 2016, 2015. And we see that the profit margin actually has increased. In 2015 it's 23%, 2016 23%, and then 2017 it increased to 27%. So we want that number to always be increasing. We do want to compare it to our competitors and see how we're doing against our competitors, but we also want it as an internal scorecard. We want to say, are we being more efficient with our resources? Can we make more money with less resources? And if that number is going up, that means that we are using the resources more efficiently to produce more revenue. So this is fantastic. We want this increasing, and it definitely did increase from 2016 to 2017. Then we just need to monitor it going forward to make sure that they can actually maintain those margins. Next, let's go ahead and calculate the EBITDA margin. And to do that, we're going to do equals. We'll come over to the income statement, go down to EBITDA, and divide it by revenue. Hit enter, and we get 9%. We'll copy that over. So, it's sort of like a up and down. In 2015 is 11%, 2016 7%, and 2017 9%. Once again, we kind of expected it to fall because of that acquisition, and so we see that it has recovered after the acquisition, but it still hasn't gotten back to pre-acquisition profitability. So down here, when we were looking at growth metrics, it was hard to understand how well the company was doing. We saw that EBITDA shrunk by 11%, and then it increased by 34%, but we were like, well, what does that mean exactly? Well, using these profitability metrics, we can actually see what that means. That the margins were actually not terrible. They weren't negative margins, but they still weren't fantastic. In 2015, we had 11% margin, which for a food retailer, that's actually really good. And then dropped down to 7%, and then we kind of clawed our way back up to 9%. And most likely it went up to 9% because we increased our profit margin up here. So because we increased our gross profit margin up here, our EBITDA margin most likely increased as a result. But we noticed that it didn't increase as much. So from 2016 to 2017, it went from 23% to 27%. But EBITDA only went from 7% to 9%. So that means that we are still losing some things in the middle that weren't as efficient. So in total, what we can say from this company now is the company is profitable. They are increasing their profitability, but they still aren't quite up to where they used to be before the acquisition. But they are still in a fairly good, strong position that is probably at or above industry standards.